The Intelligent Investor, 5 Lessons that will make you a smarter investor. The stock market is a device for transferring money from the impatient to the patient. That quote isn't from Warren Buffett, it's from his mentor, Benjamin Graham. Graham's book The Intelligent Investor, first published in 1949, is still considered the Bible of investing. It's not about predicting the next hot stock or guessing where the market will go. It's about understanding human behavior, protecting yourself from your own emotions, and following timeless principles that work in any market. Let's explore 5 powerful lessons from the Intelligent Investor that will help you think clearly, act rationally, and invest like a pro, not a gambler. Lesson 1. Investing versus speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. That's Benjamin Graham's definition of investing. Everything else, no matter how clever or exciting, is speculation. The difference might seem small, but it changes everything. When you invest, you treat a stock as ownership in a business. You care about earnings, debt, management, and long-term prospects. When you speculate, you treat a stock as a lottery ticket, something that might go up if you're lucky or if others are willing to pay more tomorrow. Graham's advice? Be very clear which one you're doing. If you're investing, you base your decision on analysis, not on forecasts. You look for a margin of safety, meaning, you buy something for less than it's worth. Most investors think they're investing, but when they chase rising prices, check their portfolios 10 times a day, or buy because of a tweet, they're speculating. Graham warned that speculation isn't evil. The danger lies in self-deception, when you believe you're investing while you're really gambling. The intelligent investor knows that wealth isn't built on excitement, it's built on patience, discipline, and time. Lesson 2. The Defensive and the Enterprising Investor. Benjamin Graham said there are only 2 types of investors, and your success depends on knowing which one you are. The defensive investor values peace of mind. They don't want to spend their evenings reading balance sheets or worrying about interest rates. Their goal is to avoid major mistakes, not to chase maximum profits. They diversify, keep costs low, and split their money, typically half in stocks, half in bonds, adjusting gradually over time. In today's world, that means index funds, high-quality companies, and patience. Then there's the enterprising investor, willing to put in time and effort to find undervalued opportunities. This type looks for mispriced securities, smaller companies overlooked by the market, or special situations like mergers and spin-offs. They accept that it takes work, real research, to earn superior returns. The tragedy is that many investors act like enterprising speculators. They think they're beating the market, when in reality, they're just trading emotion for emotion. Graham's wisdom? The investor's chief problem, and even his worst enemy, is likely to be himself. Choose your path consciously. Either build a boring, automatic system that works quietly in the background, or dedicate real effort to finding genuine value. Just don't fool yourself into thinking you can do both. Because the intelligent investor understands that consistency beats brilliance, and that slow, steady wealth is the most reliable kind. Lesson 3. Mr. Market and Your Emotions. Imagine you own a small business. Every day, your partner, let's call him Mr. Market, knocks on your door. Some days he's optimistic and offers to buy your share for twice what it's worth. Other days, he's depressed and wants to sell you his share for half price. You don't have to act. You can ignore him completely. But if you're emotional, you'll get caught in his mood swings, selling when he's pessimistic, buying when he's euphoric. That's how Graham described the stock market. It's not a wise teacher. It's a manic partner. Your job is to use it, not to be used by it. When prices fall, that's not a signal to panic. It's an opportunity. And when everyone's bragging about quick gains, that's the time to be cautious. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Meaning, in the short term, prices reflect popularity. But over time, they reflect value. Mr. Market exists to serve you, not to instruct you. Your advantage isn't knowing what he'll do next, but knowing how you'll respond when he does it. Because investing success isn't about predicting others, it's about mastering yourself. The intelligent investor learns to stay calm when everyone else loses their head, and that's where the real profit lies. Lesson 4. The Margin of Safety. If there's one phrase that defines Benjamin Graham's philosophy, it's margin of safety. Think of it as your buffer between risk and ruin, your insurance policy against bad luck and bad judgment. Let's say a company is worth $100 per share. You don't buy it for 100, you buy it for 70 or 80. That gap protects you if the economy turns, if earnings fall, or if you simply made an error. Because even the smartest investors make mistakes, the difference is, they plan for them. The margin of safety applies everywhere. In investing, it's buying below intrinsic value. In life, it's living below your means, keeping a cash reserve, or leaving room for error in your decisions. Graham taught that investing isn't about being right, it's about not being wrong. He called it, the secret of sound investment. Warren Buffett later said those 4 words, margin of safety, are the most important in all of investing. The market is unpredictable, the future is uncertain, but the intelligent investor always has one advantage. He doesn't need to be perfect, just prepared. Lesson 5. The real meaning of intelligence. At the end of the book, Graham redefines what it means to be intelligent. It's not about IQ, formulas, or insider knowledge. It's about temperament, the ability to stay rational when others are greedy, to stay calm when others panic, to think long-term when everyone else wants instant results. Sir Isaac Newton lost a fortune during the South Sea bubble of the 1700s. He said, "I can calculate the motions of heavenly bodies, but not the madness of people." Even one of history's greatest geniuses couldn't resist market euphoria. That's the point. Intelligence in investing isn't about brilliance, it's about character. It's patience, humility, and discipline. The intelligent investor is skeptical when others are certain, and confident when others are afraid. He understands that time, not timing, builds wealth. As Graham wrote, the essence of investment management is the management of risks, not the management of returns. You don't have to predict the future. You just have to survive it. If you remember one thing from the intelligent investor, it's this: don't try to outsmart the market. Out-temperament it. True investing is less about your portfolio, and more about your psychology. It's about avoiding big mistakes, staying consistent, and letting compounding do the heavy lifting. This was The Intelligent Investor by Benjamin Graham, the book that shaped Warren Buffett and every serious value investor since. If you enjoyed this breakdown, subscribe for more takeaways from timeless financial books, where we turn classic investing wisdom into lessons you can actually use.